Welcome to our 2018 income tax webinar, everyone. Today we'll be sharing information on the new tax law changes effective in 2018 and how they'll impact you over the next 7 years through 2025. I'm Mike Kwan, a principal and partner with Steward Advisors. At Steward, we help hardworking, savings-oriented people plan for their future while incorporating their personal values. Together, we develop strategies to keep family resources effectively at work so they do what they are meant to do and last longer. Joining me today is Mike Radencich. Mike is a 25-year-plus CPA with a master's in taxation. He's a partner with Trimarco Radencich, a Chicago area tax firm. Mike specializes in working with small and mid-sized businesses and individuals. Mike's an expert in income tax consulting and has been a friend and trusted advisor for us. Over the next 30 minutes, Mike will be presenting some of the specific tax law changes for both individuals and businesses that we believe will be pertinent to you. At the end of Mike's presentation, we'll make time for questions and answers. Our objective today is to help you understand the new tax law and, more importantly, think about why you should consider new tax strategies going forward. We encourage you to reach out and contact Mike or us to discuss how we can help you save more tax dollars and keep money in your own pocket. As most of you already know, at Steward Advisors, we're in a small minority of financial advisors. We're in a group of only 2% advisors where we are always fiduciaries for our clients, no matter what we do. This means we always sit on the same side of the table as their client and have their back. We do this by asking questions and intently listening so we can provide guidance designed to make life easier and better for you. We provide objective recommendations designed to help make you better informed, make wiser decisions that are truly and always in your best interests and not ours. I'm going to turn things over to Mike in a couple of minutes, but beforehand, let's go over a summary of the issues that prompted us to partner with Mike on this tax webinar today. Most of us are used to itemizing our tax deductions. That's changing. Most people will elect to use the higher standard deduction going forward. The alternative minimum tax has changed as well. It will impact less people. You hopefully will not be subject to the higher AMT tax. If you take a standard deduction in a given tax year, you can't individually deduct mortgage interest, property taxes, or charitable donations anymore. Illinois is one of the highest real estate property tax states, along with New Jersey. And so your property tax deduction, unfortunately, is worth far less now. That's why some of you paid 2 property tax bills in 2017. There's now an umbrella that includes both state income taxes withheld plus your property taxes paid. And so now you're limited to a combined $10,000 annual deduction. So for example, if you earn $100,000 a year and withhold $5,000 in state tax, you can only deduct the first $5,000 in property taxes. And if you make over $200,000 a year, you can't deduct property taxes any longer. If you have a child under 17, you'll likely qualify for a higher child care tax credit. And the new tax law is supposed to reduce our income taxes. And for most people, you'll be in a lower tax bracket over the next 7 years. With the mortgage deduction cap being lowered and property tax deductions worth less, people may have less incentive to buy bigger, more expensive homes, and that could have implications on Illinois housing values. We have a number of clients that are generous with charities, and in order to maximize charitable tax deduction, here's a tax strategy. During a year you anticipate high income, consider batching 2 to 3 years of charitable donations into 1 year and itemize during that given year. Ideally, you'd have appreciated stock and make your batch donation into a donor-advised fund. First, you would avoid capital gains tax on the appreciated asset. Second, you'd get the full charitable deduction at a new higher deduction rate. And third, by placing the batch donation into a donor-advised fund, you retain control over when your donation is received. Now let's turn it over to Mike to have him take us through the specific tax law changes. Mike, it's all yours.
Well, thank you, Mike. Happy to be here. So continuing on with some of the different tax changes that has happened with the Tax Cut and Jobs Act. One of the bigger things too is the tax on foreign income, repatriation of some of that income. It's now dropped from 34 to 21%, which is a big change. Also, change to estate tax. I'm sure most of you are familiar with that. We had, I think, right around 5.1, 5.2 million of an estate exemption in the past. Well, now that has doubled. So we're now at 11.2 million, and this will be indexed for inflation as we move forward, which will be very good. So the vast majority of people, obviously will not have an estate, tax problem. Still something to monitor, but things can add up pretty quickly, but this definitely helps the situation for most people. With that change, the step up in basis rule for inherited property will not change. You still will be able to step up the basis in property. There was a lot of talk on this, whether to just get rid of that aspect of it or not. And in the end, it stayed the same, and people will still step up the basis of inherited property. So that was a good thing. Okay. So let's look at some of the bigger change. Really is the change to the tax brackets for all brackets. That's individual, joint return, single, right, and head of household, all the way down the road. So a couple of things, that the rates have changed, across the board, first and foremost. Okay. And then within those new rates, the brackets themselves, the range has increased for a majority of them. So as you can see here, for instance, the 28% bracket under the prior law affected up to $237,950 for a joint return, has now been increased to $315,000 of taxable, and the new rate is at 24%. So that's just a example of some of the change there. Also on the higher end, somebody making over $480,000 and $50 that topped off the 35% bracket on a joint return, then that bracket is now increased up to 600,000, which is really a good change there too. So we got rid of the 39.6. We still have a 37% bracket for anything over 600,000, but for the most part, those rates, the rate has dropped, at least for the most part. So this is it. You can see the single rate prior to that. Take a look at that, and you can see the single rate brackets are a little. I mean, there was some benefit there, but it's not as dramatic as I'd say the joint returns. But nonetheless, the brackets the rates have all changed for every one of the brackets there. Okay, the new tax brackets for estates and a trust. This was changed and made a lot easier too as well. So we're at the top end of 37%, having the 10, 24, 35%. These rates have always been high. So it's, that's why it's best to do some planning and talk about this. You really only, this comes into play if you want, people want to have the trust returns pay the tax. That's why you can see the desire is probably much better for that income to pass through to the beneficiaries, if you will, or whoever's benefiting from that trust. But some planning might need to be considered. So that's something you should be able to talk to your financial advisor on, and attorneys, the state attorneys, and things like that. So. But these are the new rates for the estates and trusts. Okay, another big change for everyone is the standard deduction and the personal exemption. First off, the personal exemption is no more. Last year was $4,150. It's gone now for this year. And basically what our lawmakers are trying to do here is just make things a lot more simplified. Okay. So that's why you see the standard deduction go up so high here. So they're trying to incorporate a standard deduction as well as an exemption all in one. And as you can see, for singles, it's at 12,000. Joint and surviving spouses at 24,000. You still have some additional for elderly and that type of thing that'll be added on to that. But 12 and 24 are the new standard deductions that we'll be using. And as Mike mentioned earlier, a lot of people will probably make use of the standard deduction here for joint and for single. So that therefore itemization might not be in the picture moving forward for some people. Always something to consider and make sure that charity makes a big factor of that. And Mike mentioned about increasing each year and looking at a 2 to 3 year span for your charitable giving. Those are all things to consider and make sure you talk to your tax advisor on too as well. So. Okay, the long-term capital gain rates, basically we still have the same 0, 15, and 20% rates. Just to make note of here, the brackets have increased a little bit, not a huge amount, but it has increased a little bit. So just something to keep in mind there. Just remember, as a reminder, short-term rates are at your ordinary rates, which go back to the original tables that we have. So anything sold within 1 year is going to be taxed at ordinary rates. Another really good feature here is people with children. The child tax credit has been increased from $1,000 to $2,000 per child, which is great. And the real good thing out of that is that's obviously good in its own right. The other really good thing is a lot of people weren't able to capitalize on the $2,000 credit because of their income levels. If you recall, most people started phasing out of a child credit when their income reached $110,000 during the year and phased out by $130,000. Well, now that adjusted gross income now is up to $400,000. So you can see a lot more people are going to benefit from the child tax credit, and just something to make note of and make sure we don't omit that for your returns going forward. Okay, so some other changes to the itemized deduction. A repeal of a P's limitation on itemized deductions. That is really, there was an overall limitation. Once you receive, your income on your adjusted gross income was a certain level, they would lower some of your itemized deductions. Maybe some of you realize that or not, but these are really for high income earners. That's what would happen. Well, they definitely repealed that. So that won't apply anymore going forward. Medical expense deduction was expanded from 7.5% for 2017 and 18, and then it's going to be 10% medical thereafter. So that's a nice thing, and that'll affect everyone. So the big one, as Mike mentioned, real and personal property tax and state and local income tax, the combined limit to $10,000. And I've obviously been hearing a lot from a lot of people, and the important thing to remember there is, and it affects it probably affects almost everybody here in Illinois for the most part anyway. The reason the lawmakers were really focused on this a little bit was, if you take, you gotta consider California, New Jersey, Illinois, New York, maybe a few other states where they're paying higher real estate taxes and proper state and local tax. Outside of those, most of the states in this country do not pay as much in those taxes. So this was kind of a way to level the playing field across the country as far as what people can take for a deduction. Okay. And I totally understand. I'm affected just like everybody else, but I think for the most part, I think it's a good, I think it was a good change in a sense that it levels the playing field. It wasn't really, if you step back and think about it, it wasn't fair for somebody in a lower tax state to pay more federal income tax because they didn't have those deductions than say somebody in our state. So, I know that's not going to make too many people happy one way or the other, but that was the rationale behind it, and that's the reason for it. Okay. Foreign real estate properties are not allowed any further. So if you bought property in Latvia and you were deducting your foreign property taxes, you can't do that anymore. So be good. Let's see. Mortgage interest. We always, the prior law, we had $1 million limit on, you can buy a house for $1 million, have a loan for $1 million, and you can deduct the mortgage interest. That is going to change after 2017. You'll be limited on $750,000 of debt that you'll be able to deduct interest for. So, as Mike mentioned, that's obviously going to impact the housing market to some degree. Maybe not a ton of people, but might be some consideration, maybe one way or the other, whether or not you want to, buy that bigger house, or put that swimming pool in or whatever. So anyway, the code and the act eliminates the deduction from home equity interest after 2017. So that is in the law, and that's the way the law is right now. I've heard a lot of talk from a lot of people and my clients about they've heard the IRS is going to allow some improvement on your home for, if you do something on your house, they're going to allow the interest on a home equity loan and things like that. I have not seen anything firm on that. I know there's a lot of talk about that, but as it's written in the law right now, it is not deductible. So in order for that to happen, I know the Congress would have to amend that to give the IRS some authority to allow them to do that, or for Congress just to change it themselves and make the change. My feeling is that they wanted it this way for a reason, and so that's the way it is right now. I really don't believe the IRS has the authority to change the law, if you will, from what I see here. So all I want you to do is think about that, and you need to talk to your tax advisor at year end. And if I hear more information, obviously we'll try to, get that out to people and stuff. But right now, that's the way it stands right now. And I do not see anything firm that we can deduct any of that interest. Okay. The important thing on the home equity, though, you still can use it for, if you borrow money for your Schedule C or Schedule E for a property or whatnot, that interest can be deducted on those schedules. So that's something to keep in mind. And maybe, for tracing rules, as long as you can show that money was used for those, for your business or for buying a property or whatnot, you would be allowed to deduct that interest. So definitely keep that in mind. Okay, charitable deductions. Deductions are allowed up to 60% of adjusted gross income. Okay, so that was previously 50%, but now we're at 60%. So that's given more broader authority for people to deduct more contributions. Personal casualty and theft losses are gone. Federally declared disasters are the exception. And my personal favorite, miscellaneous deductions subject to the 2%, they're all gone. No more. So no more unreimbursed business expenses can be deducted. Tax preparer fees are gone. All that kind of stuff. So no more of those deductions. So this goes along with Congress's intent to simplify the code and simplify tax filing. That encumbered a lot of audits where people, the IRS would verify these deductions and whatnot. And rightfully so, because a lot of people would be aggressive on these things. And so this just helps process the returns a lot faster and whatnot. So that was the rationale behind that. For the tax preparation fees, as I mentioned, they're gone. But what you can do, and what you should be doing anyway, is if you have a Schedule C or Schedule E, take those deductions there, a reasonable allocation. To me, I would say you could be a little aggressive on that, taking a fair amount, because usually when preparing a return like that, a lot more time is spent to your Schedule C or E anyway. So it's just something to think about, and you could talk over with your tax advisor on that. Gambling losses, again, losses are taken to the extent of your gambling winnings. Okay, that's pretty much where we're at with that going forward. Okay, alimony. Alimony payments will no longer be deductible. This is effective for divorce decrees executed after December 31st, 2018. Okay, so the rationale here too is the IRS. Basically what happens is, if somebody is in a divorce, one spouse would deduct, the amount that was given to the other spouse, and then the other spouse would have to pick up that income in the same equal amount. Well, as you can imagine, there's always contentions sometimes between couples, and sometimes those, one was not picking up the right amount, and the other one, just made assumptions of not picking up certain amounts. And so there'd always be a lot of contention with the IRS, and the IRS is trying to figure it out, and a lot of wasted time and effort, as you can imagine. So what's going to happen now is, obviously, the alimony payments are no longer deductible, and whoever earns the income will have to pick it up on their return. So essentially what's going to happen is, whatever, the other spouse, if they're awarded income, they will probably just get an after-tax amount rather than a gross amount. So that's probably what you're going to see from attorneys moving forward, that they'll figure an after-tax amount that you'll be, the person will be entitled to, and then that just covers it. And there's obviously no more issues with the IRS as far as who's picking up what and everything. And to me, that's a big thing. I've run into that myself with certain clients, and it's sometimes spends a lot of extra time and a lot of wasteful time to do that. So that was the logic there. Qualified moving expense reimbursements no longer excluded from income. That was another change. Okay. Roth IRA recharacterization rule repealed. No more mulligans. Okay. So you will no longer be able to recharacterize the conversion of a traditional IRA to a Roth. Can unwind a Roth conversion. Okay. I know a lot of people would do that, and which was a good thing at the time, but they've closed the loophole on that one. So no more on that. Rollover plans. Okay. That's, just some other information there. Next, individual mandate is gone. So this was obviously the penalty for not having health insurance. This will be permanently reduced to zero after 2018. So the other Obamacare provision, it still remains. I'm sure a lot of you are familiar with they call it the NIT, which is the net investment income tax. And then also the 0.9% additional Medicare tax on wages over 250,000. Those are still in effect. There was a lot of talk about them removing these. That hasn't happened. It ended up still staying in the tax code. So just be aware of that. Okay, alternative minimum tax increases the exemption from 164,000 threshold to $1 million. The good news here is, I know a lot of people are going to be thrilled about this, is that a lot more people will not fall into AMT, which is a really good thing. Most people didn't understand it. Most people, didn't want to accept it, and I was one of them. So, but it's a good thing that more and more people will not be hitting the AMT portion there, which is good. Another thing affecting this is a lot of things that would help throw people into the AMT was the deduction of state and local and real estate taxes, especially if you had multiple properties or whatever. That would throw a lot of times people in AMT, and it's basically an add back for AMT, causing that to happen. But obviously, with the reduction back down to 10,000 of real estate taxes, and the combination of them expanding the threshold, a lot less people are going to be hit by this. So that is, if there's anything really good out of this, this is one of them. So let's see. And this will be indexed for inflation after 2018 as well, which is good. Okay. Okay. So on the business side here, there's a deduction for qualified business income for individuals. So if you have a S corp or a partnership or a sole proprietorship, there now is a 20% qualified domestic, a 20% deduction off of that income. Okay. Now there's a lot here, and I really don't have the time to get into it, but it's something you should, consult with your tax advisor on. There's some, different things here that you have to, concern yourself with, but I just want you to know it's available. This will help reduce your individual income tax. So if you do have a business, definitely think about it and consider it for sure. Okay, for the qualified business income, as I mentioned, qualified businesses like Schedule C or F, S corporations, partnerships. The important thing to remember too is it does not include any dividends or interest income or capital gains. So say if you had a partnership that had a lot of investments in it, and that's pretty much what it is, you're not going to get the qualified business deduction from that. Okay, so again, dividends, interest income, capital gains do not count as business income. Okay, another thing to consider, specified service business, as you see listed there. A lot of those businesses are subject to two limitations: the 50% of W-2 and a limit on taxable income on their return. So if you're in any of those service fields, you're going to have limitations on deducting that 20% deduction. So definitely something you have to work with your tax advisor on, and they'll walk you through a lot of those steps, and just something to watch out for there. But definitely a good thing. Back to the C corporation, tax new corporate rate is 21%, and a lot of talk has been about whether I should switch my S corporation to a C corporation. Again, everybody's individual company and situation is different. Definitely something you should consider, but the only thing I caution people on, that's where we're at today. And even though, I find that a lot of it's almost a break even with the new deduction and whatnot, you definitely could consider it, but just remember, the Congress and lawmakers like to float with this rate. If we see a new administration, you might see the corporate rate go up from 21%, back up to 20, 5, 28, 30. You just never know. So, so if you switch to a C corp, one thing to remember, you have to stay that way for 5 years. You can't just be flipping back and forth between a C corp and S corp and that kind of thing. So just something to think about, and you definitely should work with your tax advisor on what's appropriate for you. A lot of changes is depreciation. They're expanding the ability for businesses and individuals to deduct depreciation. So they're 100% for bonus. Is a good thing. So if you need equipment in your business, these are the years to do it. It's a lot of good benefit for it. Okay. Luxury autos, they're expanding that as well. As you can see in 17, the depreciation rules were very limited. So they finally caught up with the cost of vehicles in my mind. So that's why we have better depreciation. As you can still see, I mean, we're getting better, that's for sure. But if you have a $60,000, $70,000 vehicle, it's still going to take some time to deduct the full price of that if you do buy it. Also, something to think about is lease options. Sometimes those might be a better situation for you. Again, something to talk to your tax advisor about. Here's the Section 179 expensing. Works a lot like the bonus depreciation. They've increased the limits. You can do up to $1 million of Section 179, and the phase out starts at $2.5 million. So this is all good. Just more of an expansion of what we were doing in the past here, and all good things. It's all trying to help businesses deduct more stuff. So it's all good. Okay, another big thing here, no deduction for entertainment. Businesses cannot deduct any entertainment going forward. Membership dues have they haven't been deducted for a long time. That continues to hold true. But you still can deduct 50% on qualified meals and beverages. So that's still in play, but you definitely should segregate your meals from entertainment and whatnot. Okay.
Thank you, Mike. For those of you who, we covered a lot of territory there. If any of you would like a copy of the slide presentation, just send us an email and request a copy, and we'd be happy to share that with you. Mike, let's see if there's a few questions we can address. Here's the first one. What's the tax question that you're getting most often?
Well, I think for the most part, the biggest question, I think the biggest concern for people here in Illinois is obviously the real estate and state income tax deduction, a limit of $10,000. That seems to be getting the most curiosity and most people upset, quite honestly, from it. But you know, as I try to explain to all my clients and anybody that does ask me that question, you got to remember what the logic was from Congress, why they're doing it. It wasn't intentionally trying to penalize just people in Illinois, but I would say California, New York, Illinois, New Jersey, and maybe a handful, a couple more states. These states are the ones that have the highest real estate taxes and state income taxes, and those are going to be the hardest hit. But the vast majority of states in this country do not pay those kind of taxes. And when you think about it, it's kind of unfair that they would pay, those other states would pay lower or higher federal income tax because they don't have those deductions than say people in our state and whatnot. So the whole idea is just to level the playing field for the whole country, so it's more evenly distributed as far as deductions go. Okay, people obviously do secondary homes and all that kind of stuff, and for real estate taxes, and that was a great benefit. But a lot of people don't realize too that was actually throwing them into the alternative minimum tax as well. So even though you might have thought you were getting the deduction on your itemized return, but if you were an AMT, you probably weren't getting the benefit of those anyway. So this just makes things a little bit more level playing field and just more consistent with the rest of the country, really. So, but yeah, that's one of the bigger questions I get most often.
And Mike, I'm seeing a follow-up question to provide a little clarity around the $10,000 limit.
Yes.
Can you go over what is included in that $10,000 limit?
Yes, I can. So basically includes your real estate taxes and your state income taxes. Okay, the limit is $10,000 in total. So I would say majority of people, just say an average person might be paying maybe $5,000 in state income tax and maybe another say $8,000 in real estate taxes on their home. That would be a total of $13,000, but your limit would be only $10,000, so you'd only get a benefit of $10,000.
Okay, I think that helps. Thank you, Mike.
Yes.
The next question is: it sounds like the tax law has been simplified. What should I be thinking about now?
Right now, I think it would be all strategies right now. And one of the things we talked about earlier, I think for a lot of people, would be like charitable deductions, donor advice funds, as we mentioned. These are all, ideas of maybe bunching up your charitable deductions. Instead of looking at charitable deductions year to year, maybe you want to think about, what am I going to do over the next 2 or 3 years, and make all those deductions in one given year. This will help you, help you get over that itemized deduction, or the standard deduction of 24,000, and allow you to itemize. And then the other, 2 years you would just do the standard. But that's one of the strategies there as well. The other strategies, obviously, if you have if you do have a business, you have your 20% deduction. So there's a lot of things you can do from your business end that you can maybe strategize and maybe allow you more of a deduction there. So those are a whole host of things, but I think on the individual level, the charitable deductions is probably the biggest planning point, I would think, to think about, because that's one area that you can control mostly.
Right. So Mike, I do have one other follow-up question. It sounds like a question that perhaps I can address, and it's right within that realm of, how does the donor advised fund work and how do you set it up? And essentially, a donor advised fund is a vehicle that allows you to take multiple donations, whether it's cash or whether it's an appreciated asset, and put it somewhere where you would be donating to a 501c3 charity. And so whether it's your church or designated charities that have to do with the environment or animals or children, or people in countries that can use more help, whatever it might be, if you have significant donations, you can put it in this donor advised vehicle. We happen to use, we can't do it directly through Steward, but we do it through Fidelity's charitable group, American Endowment Foundation, National Christian Foundation. We have clients who are using all three of those vehicles. And essentially, this time of the year, they get pretty busy. So if it's something that you're thinking about doing, we would recommend that you talk with us very, very quickly, probably in the next week to 10 days, so that if it's something you want to do for 2018 and it's a high income year for you, we should be addressing it soon. And if you think 2019 is going to be even a higher income year, where the value of the deduction might be greater, then you might want to just defer this strategy until then. So with that, Mike, I want to thank you for your time and sharing your tax expertise with us. And for those listening on the webinar, we appreciate you joining us today.
Oh, no problem. Glad to be here. Thank you very much.